The marketing department of Metroline Manufacturing estimates that its sales in 20X3 will be 1.5 million. Interest expense is expected to remain unchanged at 35K, and the firm plans to pay 70K in cash dividends during 20X3. Metroline Manufacturing's income statement for the year ended December 30th, 20X2 is given below, along with a breakdown of the firm's cost of goods sold and operating expenses into their fixed and variable cost components. Income statement. Metro Manufacturing for the year ended December 31st, 20X2. Please take a look at it. Fixed and variable cost breakdown. So within the cost of goods sold, a certain portion of it is fixed so its certain portion is fixed 210K. The remaining is on variable is 700K. Under operating expenses, a portion of it is fixed is 36K and variable is 84K. Okay, please take note of this. Any questions so far? Use the percentage of sales method to prepare a pro forma income statement for the year ended December 31st, 20X3. Pro forma income statement for the year ended December 31st, 20X3. I want to highlight to you 20X3 is a future period. The question states, Marketing Department of Metroline Manufacturing estimates that its sales in 20X3 will be 1.5 million. So you have the forecast sales revenue of 1.5 million for the year 20X3. Let us find the value for cost of goods sold. Refer to the table. You can see cost of goods sold and sales revenue for the year 20X2. Next, find cost of goods sold percentage equals to cost of goods sold divided by sales revenue. Use the figure from 20X2 and we find that the answer is 65%. We use 65% times the sales revenue of 20X3 and we'll find the figure for cost of goods sold. Sales revenue minus cost of goods sold gives you the gross profit. Let us find the value for operating expenses. Refer to the table. You can see operating expenses and sales revenue for the year 20X2. Let's find operating expense percent equal to operating expense divided by sales revenue. We'll be using the figures from 20X2. The answer is 8.6%. We use 8.6% times the sales revenue of 20X3 and we'll find the figure for operating expenses. The gross profits minus operating expense gives you earnings before interest and tax. The question states, interest expense is expected to remain unchanged at 35,000. So we have interest expense at 35,000. Earnings before interest and tax minus interest expense gives you net profits before tax. %40 times net profits before tax gives you taxes. Net profits before tax minus taxes gives you net profits after tax. Question states, the firm's plans to pay 70,000 in cash dividends during 20x3. So you have less cash dividends of 70,000. Net profits after tax minus cash dividends gives you to retain earnings 146,600. Please spend a moment to look at the pro forma income statement. Use the fixed and variable cost method to prepare a pro forma income statement for the year ended December 31st, 20x3. Here we look at the second method, fixed and variable cost method. This method is more complicated than the first method, so please pay attention. Same thing, the future sales is at 1.5 million, forecast at 1.5 million. You less the cost of goods sold. You have the fixed cost here, the fixed portion. Right, the fixed portion here is expected to remain unchanged. We have made the assumption that expect to remain unchanged. So this, given the question, 210K. For variable cost here is the past year figure, okay, 20x2 figure, the previous year's figure, 700 for the variable cost divided by the past year sales, 1.4 million, give you 50%. So you take this 50% figures, put inside here to calculate for the future value. So times 1.5 million, give you 750. Okay. So from here, you minus off the two figures here, it gives you 540. This is the gross profit. Next, we move on to operating expense. The fixed portion, the fixed cost remains unchanged. So basically it's the same as the previous year, 36K. So it's given the question. The variable cost, this is from the previous year. Okay, the previous year, 84,000 variable cost, and the sales figure 1.4 million, give you 6%. 6% put in here, times the future sales 1.5 million, give you 90. So same thing, 540 minus these two figure, minus 36 minus 90, gives you 414K. This is the earnings before interest and tax. Next, we minus off interest expense which is remain unchanged. So it gives you 379. This is the net profit for tax. Moving on, here tax is at 40%. So basically here 40% times 379, we just take from here, put it down here, 379K, give you 1516.6K. So 379 minus 151, okay, gives you 227.4K. This is the net profit after tax. So from here, the question tells you that the cash dividends in 20x2, x3 is 70,000. So it's 20x3. The cash dividends is negative 7,000, so outflow of 70,000. So remaining figure is 157.4K. This will goes to the retained earnings. Any questions so far? Compare and contrast the statements developed in parts A and B. Which statement will likely provide the better estimates of 20x3 income? Explain why. Percentage of sales forecasting technique. Key assumptions is that all costs are variable and vary proportionally with sales. Limitation is that it assumes no fixed cost, which is unrealistic. Also, variable costs may not vary in direct proportion to sales. Fixed and variable cost method technique. Key assumption is that fixed cost is assumed to be constant and variable cost to be a constant proportion of sales. Limitation is that in reality, fixed costs may not remain constant and variable costs may not change in direct proportion to sales. Fixed and variable costs method gives higher profits due to lower costs as a result of fixed costs remaining unchanged, although the percentage of sales method projects a more conservative estimate of net profit after tax. The fixed and variable cost method is more accurate.